Live. Okay. This meeting is streaming live. I am Tobias Carlisle, joined as always by Jake Taylor. This is Value After Hours. Special guest today, Michael Cow. He's Urban Cowboy on Substack and on Twitter. You Urban Cowboy on Twitter as well, Michael?
Yeah. Urban, yep.
It's a good name, by the way.
There are a lot of fakes. There's only one. There's only one.
I first saw Michael speak in 2010 at a value investing congress where I thought he gave the absolute stand-up presentation of the 2 days, which was a capital structure arbitrage. I think it was GM. We're trying to remember exactly what it was, but I'm going to take everybody through who Michael is, through his background, and then we're going to discuss a little bit of how he views the markets and what he's seeing at the moment. How are you, JT? I should check in with you first. We've just got back from Omaha, so we're all buffeted up at the moment.
Yeah, definitely do a little Berkshire review probably later in the show. But
I made my journey to Value Mecca a couple of years ago too. Yeah, it's fun.
We had a great time. Yeah, I mean, I'm starting to wonder though, Toby. I think there might be more than 10 people that listen to the show because we met a lot of people who in Omaha.
We had a really fun turnout. We had just impromptu drinks after the event across the road at the Hilton, and we got a few hundred people, I think, in that little outdoor area.
That's cool. That's always fun.
Last year, we pirated this little spot upstairs, and not realizing that because it was COVID, it was a much smaller meeting than it usually is. And then I was walking up the stairs this time to go to that area, and they had a security guard standing there, and she said, "This is not the Value After Hours podcast after party. They didn't book." So I said, "Oh, that's terrible of them. I'll go let them know." And then we headed downstairs.
It worked out just fine. We got to be outside instead, and it was a beautiful day.
It never ceases to amaze me that you've got two elderly gentlemen that can command basically 50,000 people for hours and hours and hours and hours. It's pretty remarkable.
With no bathroom breaks.
No, I know. At their age.
And they're drinking that Coke like it's water. Let me just give a quick shout out to all of the listeners. Toronto, Phoenix, Kathmandu, Rolling Hills, Guildford in the UK, Doha, Qatar, Egersund, Norway, Madison. How you doing? Aiden, Brussels, Belgium, Kennesaw, Georgia, Cardiff, Wales, Bendigo, what's up, Australia, Black Hills, South Dakota, Munich, Milton Keynes, London, Katowice, Poland, Tallahassee, Lisbon, Portugal, Wagga Wagga, Australia, how are you? Stirling, Scotland.
Oh my God.
Victoria, British Columbia, Altamonte Springs. And John de Grumman says, "Welcome, Mike." That's a good place to get going. Thank
you for having me. Wow, that's very exciting. That's very cool. You rattled off places that I'm heading to later this year.
When I saw you speak in 2010, you were running a Canthos Capital. You'd come out of Canyon. You're a Goldman Sachs guy. And even before that, you were a university student and you studied a little bit. I didn't know this until you were electrical engineering and computer science. So how did you transition from that into where you currently are?
Well, yeah. So a little bit of background then. I wanted to be a video game designer growing up. I knew with 100% certainty that that's what I wanted to do by ninth grade. And I was a pretty good coder. I knew 4 different programming languages by ninth grade and all this stuff. And that's what I went to university for. During my time in college, I did a couple of engineering internships. Decided that the life of a coder really wasn't suited for me. But yet, well, this is my only skill. I know nothing about business, so I wound up. I just made like a last minute pivot, almost random in a way. I interviewed for this IT position at both Goldman and Morgan Stanley were interviewing for IT. I remember asking a couple of fraternity brothers, you know anything about these firms? Are they any good? They're like, "Oh yeah, you got, they're the top of the top, as far as investment banks go." And I said, "Okay, well, I'm interviewing for." Anyways, I wound up getting both job offers. I picked Goldman, and I got drafted into the J. Aaron group, which was, unbeknownst to me at the time, it was the most profitable division of Goldman. I think J. Aaron accounted for 30 or 40% of overall Goldman Sachs profitability. This is around 1991 or 1992. And would you believe that 21-year-old me at the time had the naivete and the perhaps idiocy to ask the partner in charge of IT for a sit down, because I said, I know nothing about commodities. What I know about Wall Street is stocks. I don't want this assignment. She sat me down. She goes, let me tell you something. You got handpicked by the most profitable division of the group, of the firm. I would take this assignment. I'm like, okay. So I wound up taking that gig. I was coding basically the GUI software for the sales traders in the FX group, in the FX options group specifically. And by then I had already taken on. I realized very early on, you know what? If I wanted to be a coder, I should have just gone to Microsoft or a company where the revenue generators are the coders. But if I'm here at Goldman Sachs and I had already gone through like a multi-month training program, and I kind of got the vague ideas of, okay, here are stocks, here are bonds, here are commodities, here are FX. This is all super exciting stuff to me. And I just took night classes and read a ton on my own, and very quickly realized, you know what, if I'm here at Goldman, I should make a go of at least trying to be a revenue generator somehow. And I kept running into these brick walls. I remember, like, during lunches, I go up to human resources and say, hey, I want to be a trader. How do I be a trader? And they'd tell me to read a bunch of books and send me on these wild goose chases. And a couple months later, I'd be done. Go back upstairs. Okay, done this. And then anyways, these wild goose chases kept happening. But meanwhile, I was just learning. I didn't know, but I was actually learning quite a bit. And a year into the job, I just rolled out my currency options module. The senior sales guy, his name was John, calls me out on the desk to kind of bitch at me for all the bugs, right, in my new program. And then, lo and behold, his biggest client, Quantum Fund, calls up. And Quantum Fund wants a two-sided market on a 500 million notional dollar Deutschmark options trade.
You got to say Soros with Quantum Fund as well. You got to let
the
younger generation don't know.
And mind you, that's right. And
this
is right after, right? This is probably less than a year after Soros earned the reputation and the man who broke the Bank of England, right? So needless to say, when Soros calls, the whole desk goes quiet. He wants a two-sided market. Everybody's guessing, is he a buyer, is he a seller? How do we quote the market? Blah, blah, blah. Meanwhile, I'm just trying to get my sales guy, John, to explain to me what the options trade was. So he sketches it out on a napkin, but he kind of gets it backward. And I just corrected him. I said, I think you got it backwards. I think it's supposed to be like this. He's like, yeah, you know what, you're right. And I thought nothing of the conversation. But like 2 days later, I get a call from Richard, so back then, Richard and Lloyd Blankfein, Richard Whitten and Lloyd Blankfein co-ran J. Aaron. So Lloyd ran trading, Richard ran sales. So they're the two senior partners there. I get a call from Richard himself, who is actually my boss's boss's boss. He's like, I hear you have a knack for options and interest in finance. Would you like to interview for a job as a analyst position on one of the desks? And I'm like, yeah. So that's basically how I transitioned. And then so I spent a couple of months as a sort of jack of all trades. I was basically precious metals analyst, but the precious metals and base metals desk. By the way, precious metals was run by a partner named Jim Riley. Base metals was run by none other than Gary Cohn. So it's a very interesting place to kind of grow up, if you will. Lots of colorful personalities, incredibly intense atmosphere. But there was a small nascent desk called the GSEI desk, which was the Goldman Sachs Commodity Index, was launched back in 1991. And there were 2 traders on that desk, and it was a very nascent product. They were selling structured notes on the GSEI. There was a listed futures contract, and Goldman was trying to make a big institutional push for, making commodities an investable asset class, right? So in my role as a junior analyst on the desk, if somebody said, "Hey, do this pet project," it didn't matter whether or not they were my sort of direct report. I just did it. I did projects for everybody. So within a couple of months, one of the 2 traders left to be a sales guy, and all of a sudden I landed a role as the junior trader, the number 2 trader on the GSEI desk. And then the next couple of years were super, super interesting, because at one point, one of the large pension funds comes in with a 50 basis point allocation to commodities. And then I found myself at this epicenter where I had to make 10,000 up. So put into perspective, GSCI those days was a 10 lot up market, right? It was literally being a market maker in GSCI basically meant that you were getting picked apart by the locals left and right, the floor traders, right? It was no fun. But when this pension fund came in, my mandate from my bosses were, you stand up to any size they want, any size, because I could always arbitrage the underlying 22 different commodities, right? So I was making 10,000 up lot markets and then arbitraging the 22 underlying commodities. It was unbelievably fun, exhilarating, and incredible learning experience.
So you at some point you've transitioned out of Goldman Sachs to Canyon. How did that come about?
Yeah, so I did that for a couple of years, and then I realized that I'm doing just technical analysis pretty much, right? And I don't know a thing about fundamental analysis or finance. So I decided to go back to business school. I went to business school in Philly, I did a very impactful internship during my business school years. I got an internship at the Harvard Management Company, the endowment fund, right? And these were the days when Jack Meyer ran that. There were two-star portfolio managers, John Jacobson and Jeff Larson. And I got to spend a summer with them. And, in one summer, all of a sudden, my world expanded. I went from technical analysis, and my idea of hedge funds were either CTAs or macro funds. That's it, right? I had no idea that there was this massive world of equity long short, convertible arbitrage, capital structure arbitrage, merger arbitrage. So I started, and this was circa 1996, 97. Hedge funds really weren't a thing. I mean, all my classmates were going to investment banking and consulting. I think I might have been the only person that was actively looking for hedge funds. And there are 2 little known shops, one of them being Citadel, that had just opened. They had 500 million under management. I went, I actually interviewed with Ken back then. I wound up getting a job offer at 3 different shops that specialized in convert/capital structure arb. And then, already after, I think the offer from Canyon didn't come in until after I already graduated. It was already during graduation weekend. And I thought, well, this is pretty cool. I wanted to be back on the West Coast. My wife is from there. And most of my, I spent a lot, basically since high school, I've been living in California. I always considered California my home. But, Canyon, their bread and butter, Canyon started by Josh Friedman and Mitch Julis, both super smart guys who I consider to be friends and mentors to this day. They came out of Drexel, and that whole Drexel diaspora. And their firm was mainly focused on credit, high yield, direct lending, bank debt. And, this is an area, obviously convert arb, capital structure arb touches upon credit, but this was pure credit. And I really had no idea about it, but I took a chance, and it worked out because, Josh and Mitch, long story short, during my years at Canyon, they let me have the ball and run with it. And I had this idea of creating a business within a business. I wrote a paper in probably circa 1998. I entitled it Alpha with Asymmetry. And the general thought was that, convertible and capital structure ARB strategies tend to be long gamma, long optionality. Merger ARB strategies and event-driven strategies generally tend to have short gamma characteristics. And the way I explain that is always that, if you think about a friendly deal where you've got a 95% chance of making $1 if the deal closes, and that 5% chance of a deal bust, you might lose $10. Well, that's awfully sounds like short optionality to me, right? And so my thought was, what if I created a business where these two asset classes could be paired and systemically hedge one another? But if you could be very smart and diligent about security selection, you might be able to create alpha with a lot of asymmetry. And so that was the strategy that I started and ran at Canyon, and then wound up porting over to my own firm in 2002.
So let's just talk a little bit about Acanthos. What were you doing? So in a little bit more detail, and we'll go back through what you've said, because this is a value podcast. We might need a little bit more explanation of some of those terms.
Sure. So, sorry, rephrase the question. What was I doing at Acanthos?
Tell us a little bit about Acanthos, and then we'll go through those strategies just a little bit more, so that, because for the most part we're vanilla long only value here, and we probably need some more explanation of some of those things.
Greek terms.
Yeah. So look, I think by focusing on, so I was at Canyon, the portfolio that I ran was always very convertible centric. And the reason why I chose the convertible asset class to focus on was, one, there really was no single analyst at Canyon focused on it, because most people were focused there on either senior secured debt or senior unsecured high yield debt, right? And convertibles are an interesting asset class because they touch upon credit, obviously. They also touch upon equity valuation, and they obviously also touch upon optionality, right? And that's very, very appealing to me. And in that period of time, also, convertibles as an entire asset class, I would say, were a value asset class, because they were pretty mispriced. I remember giving this pitch to investors all the time, that I wish I had a graphic to show you, but if you think of the proverbial hockey stick of an equity option, right? Now think about it from the standpoint of the Merton real options model, right? So if you think about a firm's equity as a real option on its assets, you can now think of that as, okay, the strike price of that option is the amount of debt, because by the accounting identity, right, equity equals assets minus liabilities. So that equity option is basically a call option, right? I'm going to try to frame it in right. It's a call option on the firm's assets. But debt, to the investor standpoint, is a short put. So let's see, if this is a call option, then a short put looks like this, right? And so why is that? Because the strike price of that put, by the way, is the amount of assets that are required to make the debt whole at par. Because if you think about it, right, when you buy a bond, you have a fixed income upside. You are getting your upside purely by the coupon and the yield, right? That's actually akin to the premium that you get from selling an option. But why is it a put option? Well, it's because that if the underlying equity, if the assets exceed liabilities by so much and stock goes to the moon, well, the bondholder is just going to get par at the end of the day, right? So, but what happens if the underlying company falls into financial distress, where the asset value of the firm drops below the par amount of debt outstanding? Well, then your bonds have equity-like downside. So you are short a put on the firm's assets. So this is the holistic way that I think about capital structure, period. Because to me, equities, bonds, they are all part of a continuum of value across a firm's capital structure, and where the fulcrum resides. And what I define by fulcrum is the fulcrum is that part of the capital structure that has the most asymmetric movement based on a change in the firm's enterprise value. So let me say that again. If the enterprise value obviously is the equity value plus the amount of debt, right, in a company's overall value. If you have a company with no debt, then the market cap equals the enterprise value, right? You have to also subtract out cash, right? So that's right. So there, in that case, the fulcrum security can only be the equity, because that's it, right? Change in enterprise value directly manifests in change in equity value. But what if you have a very highly levered company where most of the enterprise value is the debt value? Well, if the asset value exceeds the liability value, right, the fulcrum could still very well be the equity. And in fact, the attractiveness of buying a levered equity that's been pounded down by exogenous factors, but where the company still has strong cash flow, well, you can find very, very asymmetric opportunities in fulcrum equities that way. But during the great financial crisis, for instance, the credit stress was so severe that in many cases, the fulcrum securities became debt, subordinated debt, like in my specialty, convertibles. So
can I just ask, why is that the case? Because that you're not unlikely to collect on the equity, and so it's much more likely to fall through into some sort of bankruptcy proceeding, in which case you want to be.
Yes, I'll give you an example. So probably my career winningest trade of all time was buying distressed convertibles in General Growth Properties, which was a very, very levered retail REIT that went into bankruptcy in 2008, right? So if memory serves, and this was a company that had something like 25 billion of senior secured debt, right? Basically mortgages, right? And then below that, I can't remember the exact number now, but let's say that it was a sliver of senior unsecured debt. I want to say maybe 2 or 3 billion worth. And a big chunk of that senior unsecured debt was its convertible bonds. And then beneath that, you had the equity. Well, at one point, right, when, in 2006, 2007, asset values were this high, right? So you take the entire debt stack, you have, like I said, you have 25 billion of senior secured, tiny sliver of senior unsecured, and then the equity. Well, the asset value was so high, right, that all the debt was basically worth par. And then you had this massive equity market cap. But the level of credit distress during the great financial crisis was so high. And by the way, I still laugh at how people compare this current regional banking crisis as anything close to GFC. It's just not anywhere close. But at any rate, at that point,
yeah,
but I don't think that's what this is. But anyways, the equity, not only had equity been wiped out, even that layer of senior unsecured debt was trading down at 4 cents on the dollar. I could buy convertible bonds at 4 cents on the dollar. And the reason for that was in 2007, if you remember, in 2008, if you remember, even DIP financing, debtor in position financing, which is basically senior secured financing offered in bankruptcy, even that had dried up. And so you had very, very levered companies like Circuit City, for instance. They had to liquidate. They had to go into a Chapter 7 liquidation. There was no reorganizing that equity. There was, they literally had to liquidate their inventories and receivables in a vacuum. And so it was with that backdrop that people priced the securities in the general growth properties capital structure similarly. But the variant view that my team and I had at the time was this is a very different company than a distressed purveyor of, tech of, TV sets and refrigerators, right? Its properties were basically A properties that still had 90+% occupancy. So we basically made a very, very strong directional. So the way we got into that trade, to talk to you a little bit about the flavor of what we did at Canthos, was it started off as a convertible arbitrage trade. We had on some of the convertibles it was long before they went into financial distress, and we were short the equity, right? And at one point, right, during the cratering of the entire capital structure, the equity gets wiped out, but the convertibles themselves go into deep distress territory, and that's when we essentially covered all our hedges, but massively sized up, as in like we 10x'd our position in the convertibles at like 4 cents on the dollar, because we said, you know what, the implied, so remember the debt stack is here, the convertibles are here. The implied equity value went to something like all the way down here, right? And so when I talk about the fulcrum security, right, a tiny movement, our bet was that any recovery in asset value right here would disproportionately accrue to the fulcrum layer. And the fulcrum layer here was definitely the bonds. And I remember Bill Ackman at the time, he was very well known for making a contrarian view on the equity. He was buying the equity at a couple cents per share. But our view was that was actually a much worse trade than ours, because we wound up buying a senior security at 4 cents on the dollar, right? And at one point in 2009, when the bonds had gone from 4 cents to 70 or 80 cents, now we were already sitting on like a huge amount of gains at that point, but I perceived a different type of trade now. What we then did was I remember, now I thought that the fulcrum was jumping to the equity layer. At this point, the equity might have 10x'd, right? The equity might have gone from 30 cents to $3, okay? Now remember where we are in the cycle. The bond, if the equity is worth $3, my convertibles should be worth par, right? I had already made a huge amount from going from 4 cents to say 70 cents. But the thought in my head was, well, what if I did this trade? What if I shorted the converts now at 70 cents, right? Because I still didn't know at that time in late 2009 whether or not this recovery was going to hold. So what if I shorted the bonds at 70 cents and went dollar for dollar long the equity? Now, why would I do that? Because my perception was that if this economic recovery was taking hold, right, then asset values would go back up to here, right? All I could lose on my convertible bonds would be 30 points, right? Plus accrued interest, whatever, right? But the equity, if that happened, I would make 5 or 6 times on my equity bet. The equity would actually go to probably $20 a share at that point. So we completely changed the trade. We went from convert arb down to pure distressed, right? Just balls out long the convertible bond at 4 cents on the dollar. And then when the converts went back to 70, we shorted the converts and went dollar for dollar long the stock. Then what happened was, as we all know, the economic recovery did take hold. And then before you knew it, there was a bidding war between Brookfield and Simon Property Group for General Growth Properties. Thus, my bonds went to par. I lose my 30 cents on the dollar. But my equity went from $3 to, I think it was 17 when we sold the equity. It was, so that's what I mean by like, this was my career winningest trade of all time, because like there were 3 different trades that we milked out of the same capital structure over a span of, I want to say three or 4 years. And each time with it, we didn't make money on the convert R. In fact, we lost a little bit on the first part of the trade. But on the second 2 legs of the trade, we absolutely killed it. So,
hey, Michael, what do you think about Buffett? And he tended to do a lot more preferreds during that time period than just purely long equities. What's like, does that make sense to you? Like, was he thinking in kind of fulcrum ways at that point?
Well, sure. I mean, but see, Warren Buffett though has an advantage that most people don't, right? I mean, he gets sweetheart treatment there. And so most people can't go and, say, hey, I'm going to take a, billion in a pref, right? But so I think it's great. And he usually does it as like a convertible pref, right? Mm-hmm. So that's exactly the idea, right? He's getting the protection of being senior to the equity. He's getting a very large, dividend rate, but he still retains the equity upside. So yeah, I mean that's exactly what he's doing. And I think we talked about it earlier before we started the recording. But like one of my favorite value books, the reason why I like Seth Klarman's Margin of Safety is that it talks about finding value across the capital structure as a continuum. It doesn't differentiate. It doesn't just focus on equity. Most people, especially the retail crowd, just thinks of equity. But most of the money I made in my career was actually buying distressed bonds. So yeah. Anyways.
One other trade I've heard you talk about was the El Paso in about 2005, El Paso convertibles. Do you want to walk through that one a little bit?
Yeah, so that was another interesting setup. I'll say that this was one of my most interesting trades that never made any money. It never made any money because I gave up on it, and eventually, the event that I wanted to be exposed to never happened. But long story short, so again, I back then I tended to focus on the convertible. The first time I look at a capital structure, because again, the convertible informs where I need to go, right? Whether I need to focus more on the equity or on the bonds. And so I remember my analyst at the time said, hey, there's a really interesting convertible with like a 1-year maturity, trades at roughly 90 cents on the dollar, about a 10% yield to put. So we discussed it in committee, and we looked at it. We're like, wow, this is a pretty levered company. It's a pipeline company, but pretty levered. There was a lot of senior secured debt above the convertible layer. And I said, the senior secured debt, I believe it was a revolver, was yielding just a little bit less than that bond. It was maybe yielding like 8% or so. I said, well, why would I want to, I would rather be in the top of the capital stack rather than be in this security that's artificially held up, right, in dollar price. And the reason why I knew it was artificially held up because of its imminent maturity is that there was a pari passu bond that was a longer dated bond in the capital structure. I think it was maybe even a 30-year maturity bond that was trading around in the mid 70s. So the formulation,
so when you say it's artificially held up, it's because it's just about to.
Yeah,
it's a year away from.
Right?
Yeah,
but this is what I mean. This is what I mean by the short gamma aspect of event arbitrage. Just like a merger arb deal, where the spread is artificially held tight by the high probability of deal closure, the price of a bond that's about to mature is artificially held up by that event, that by the event of maturity. But what if the shit hits the fan and there is a default event? Well, then that bond that's about to mature has the farthest to fall, right? I used to tell my analysts, and I've tweeted this out on numerous occasions, the tenor of a bond is irrelevant in bankruptcy. It's irrelevant in bankruptcy. And so that informs our trade formulation. So what I did here was I wound up, instead of going long that convertible that my analyst recommended to be long, I wound up shorting. And I shorted it against that long piece of debt in the same capital structure, trading around the mid 70s. And then I went long the senior secured revolver. There's 3 pieces to the trade. What, in my mind, what I was forming was I was forming a synthetic event convertible. So
like a
here's
CDS almost.
No.
Okay.
More like it's a synthetic event option, and I'll explain to you what I mean by that. A synthetic convertible bond is what I mean by it, because in a convert, if you think about it, you're getting paid to wait, you're getting paid a coupon, right? But you have optionality on the upside, right? Here, I'm getting paid to wait by being long the senior secured, paying me 8%. And that piece of paper I viewed as bulletproof. The company could go bankrupt and I'm going to get that 8% because I'm so senior in that capital stack, okay? But if the company went bankrupt, my capital structure R, where I'm short the convert and I'm long that long piece of that long bond, those two converge, right? Again, what I say in bankruptcy doesn't care about tenors, right? So that 90 cent on the dollar convert is going to converge down to where that longer piece of debt is trading. Or it could be the opposite. Maybe there's a happy medium where the actual asset value justifies 80 cents on the dollar, and my long bond goes from 75 to 80, and my short bond goes from 90 down to 80. In either case, I'm covered in bankruptcy. I make money in bankruptcy. But there were also rumors at the time that Chevron Texaco was looking at acquiring El Paso. Well, then you have to break down your event arbitrage analyst hat and say, okay, how do I get screwed, or how do I make money here? If they were bought for cash, usually bonds have a change of control put at par on a cash acquisition, right? So what that means is if El Paso gets bought for cash, then any bonds with that change of control language snap to par. So in that case, right, my 90 cent on the dollar bond snaps to par. I lose 10 cents. But my 78 or 75 cent on the dollar bond snaps to par, and I make 25 points, right? And again, I'm still clipping 8% on my senior secured. So that I'm covered in a cash acquisition. But what about if it was a stock acquisition? And this is what I got most excited about, because in a stock acquisition, the change of control puts don't necessarily get triggered in a stock acquisition, but the underlying debt essentially gets assumed by the acquiring company, and it becomes the credit of the acquiring company. Now, El Paso was a very levered credit. I can't remember the credit rating, but I'm going to say that it was close to a C, triple C. It might have been like a single B, about to get downgraded to C or something like that, right? It was very levered. But Chevron Texaco was like either A or double A at the time, right? So here's what would happen on a stock acquisition. Again, senior secured revolver, nothing happens. I'm still getting my 8%. In fact, that would actually trade well above par at that point, because that 8% senior secured revolver probably reprices to yield 3 or 4% under a single A credit, right? Now, the convertible bond is callable and puttable at par. Same thing. It can't go much higher because it's callable and puttable at par. It really can't go much higher than par. can lose 10 points on my convertible short. Okay. But what about my long bond? A 30-year duration trading at 75 cents on the dollar. If that bond all of a sudden gets rated to single A, it goes up to 130 cents on the dollar. It goes up like 60 points. So I loved this trade. But unfortunately, it was a pre-GFC trade because pre-GFC, I ran my book very differently than post-GFC. Pre-GFC, I liked, in fact, my secret sauce, my LP, what my LPs liked most about Cantos and what we did was that we were very, very creative in taking disparate pieces of the capital structure, like I just explained, piecing them together to form a very asymmetric option, right? And at really no cost, because I was getting paid here, I was getting paid to wait here, and completely covered in all circumstances, whether it's bankruptcy, cash takeout, stock takeout, right? Or nothing happens. Basically, long story short, this turned out to be one where, I held it for quite some time. I clipped the coupons. Nothing really happened. I wound up just taking it off. You're right. But I at the time, I viewed my portfolio as a very eclectic collection of these types of payoffs. And then obviously post GFC, the reason why that changed was that these trades require the balance sheet of PBs, right? So I was able to lever the equity in my portfolio by 2.5 to 3 times, which was actually lowly levered when you compare. Most convert ARBs back then were levering anywhere from 4 to 8 times. And so we were on the low leverage side. We were on, call it like 2 to 2.5 times on average. But that's also what saved us during GFC, because when the convertible asset class essentially got destroyed and became rehypothecatable by the PBs forced a lot of my brethren out of business by forcing them from a starting point of, say, call it 5 times leverage down to 1 in the space of like a month. And in a total vacuum of dearth of bids, right, during the financial crisis. So it was a very, very challenging time. But post Dodd-Frank, post GFC, the prime brokers didn't have these magnanimous terms on extending balance sheet. So we had to evolve, right? So we became much less levered and more directional in our bets.
Mike, you're a family office now, and you still got your license, so you're careful about the way you describe the trades that you've got on. So a lot of your public commentary tends to be more macro. Can we just talk to you a little bit about how you feel about? Let me throw some ideas at you. How do you feel about energy?
Well, energy is the area that I've been focused a lot on for a long time, because again, going back to my Acanthos days back in 2016, we were focused on a lot of the distress in the sector. When oil cratered in 2014, 2015, there was a lot of financial distress. And there was a very levered upstream MLP that went bankrupt in 2016. And then we joined a hedge fund group led by Elliott, where we were owners of the senior unsecured bonds in this capital structure. We came to an agreement with the second lien holders. We gave the second lien holders the legacy business, and then we recapped the company, added new capital in, bought out the crown jewel assets, hired a new management team, and basically formed a new company to harvest this asset. So the reason why I still have my investment and advisor open is that I essentially have a one asset fund now that's in this post reorg private equity. On my personal balance sheet, it's a significant bet on the long-term prospects of oil. So my view on oil macro is very nuanced. I do think that the ingredients for another shale revolution that period of time where between, call it 2014 and 2018, I view as very, very idiosyncratic. You had the confluence of shale coming into its own at a time where a lot of long cycle projects just got turned on, and they basically crushed the prices, right? So what that then did was it led to a dearth of long-term investment. Shale was very, very undisciplined at the time, and the management teams were compensated on just production as opposed to profitability. And so our model was very, very different. We always decided we would leave capital reallocation decisions to the equity holder, and we would distribute out earnings, which is what's happening now with my company. But the reason why I have a very long-term view on oil is that I think between the dearth of long-term capex, the non-lasting nature of the shale revolution, I think most of the best locations have been drilled out. I'm not saying that there is a shortage of oil. I think there will be a shortage of cheap oil. And when the Permian peaks, probably sometime next year, at some point the world may very well. Oh, and of course ESG, how that's completely redirected capital spend. At some point, I do think that there is the risk that we have a very sustained period of high commodity prices. Now I say it's nuanced because in the short term, I see lots of deflationary effects. I've written at length on Twitter about this, where you've got essentially a clash of the titans between the Fed and OPEC Plus. I personally think that OPEC Plus acted way too soon. I jokingly called it a premature emasculation, because so here we get into economics a little bit. I think I really like to think big picture. I respect all the people that do the fundamental barrel counting. I try to synthesize that, but really look at the bigger picture of thinking about the supply-demand framework. And what OPEC Plus did, I think, was to avert short-term pain at the expense of long-term gain. Because if you think about where we were before the OPEC Plus decision, we had a very backwardated forward curve, which implies a very inelastic supply curve, right? And so what happens when an inelastic supply curve meets a downward demand shock, possibly from Fed hikes and synchronized central bank hikes causing a demand destruction of everything, not just oil? Well, that results in a very, very sharp price drop, and that's exactly what happened. So I've written at length since last year that the signal quality of a forward curve going from contango into backwardation can be significant, because that's the first time that the market is paying you what's called a convenience yield for spot prices over and above forward prices. It's kind of unusual for a storable commodity, right? When that happens, but so that's why there's signal content when the forward curve first moves from contango to backwardation. But the reverse is much more difficult, because when you have a forward curve that's already in backwardation, it's very, very hard to forecast when that downward demand shock happens. And so I think that caught a lot of people off sides. And now what OPEC did was it essentially, so you had a very inelastic supply curve, and then you had a downward demand shift. What OPEC did in its cut was it shifted the supply curve back up, but there's a cost to doing so, because going forward, it means that the supply curve is more elastic, right? There's that much more spare capacity in the system. right? So my view is that when the economic recovery, it's funny to talk about economic recovery when we haven't even seen the real recession yet. But so I'm thinking already 2 steps ahead. After the recession and after the economic recovery, when oil prices come back up, now the price move won't be as parabolic because you've got a much more elastic supply curve, right? So that's what's going through my head. So that's what I mean by my view on oil is still long-term bullish. I still think it's a mistake for the administration to gut the SPR in the way it has, because I still think that that's myopic. I don't think that the shale revolution is going to be repeated anytime soon. And so at some point when US shale starts to decline, inexorably decline, then that's the scenario. I've referred to in the past that at some point we might see the supply-demand singularity point where even a recession-impacted demand might not be enough to cover the spare capacity in the world. But that scenario, I think, was now pushed out because of what OPEC did, right? Because OPEC just created a lot more future supply elasticity.
You previewed a little bit where I wanted to go there. We haven't gone through the recession yet, and we certainly haven't emerged at the other side. But what do that you're presupposing that we do go through some sort of recession, probably attended by some pretty significant stock market collapse. What are you looking at there?
Well, when you look at how much, when you look at the state of valuation in the asset markets, you look at how steep this hiking cycle has been, and it's hard for me to envisage a soft landing here. I think that there are, in a way, we don't know what we don't know. I think that there are lots of icebergs hidden in the surface. I alluded to earlier, I don't think that this is going to be a GFC 2.0. We tend to always focus on the last war. And I think that at least the large banks are extremely well capitalized. Now, regional banks, that's something different, right? And unfortunately, I do think that this march towards bigger and bigger money centers at the expense of regionals is somewhat inevitable. Unfortunately, it's not a great outcome, but I kind of see that happening. I'm more concerned about the hidden icebergs in the rest of the shadow banking sector. And I define shadow banking sector very, very loosely by including, hedge funds, private equity, venture capital, insurance companies, pension funds, endowment funds, any financial intermediary, essentially, that's ultimately in the business of borrowing short and lending long is a shadow bank. And I think that, again, the money centers are well protected, but I don't think we've necessarily seen the shoe to drop yet. And so this is why in that clash of the titans between the Fed and OPEC plus, Fed being the central bank for dollars and OPEC plus being the central bank for oil, ultimately, I think the Fed has the upper hand. And the concern I have is that when you look at core PCE over a long period of time, since the 90s, since the beginning of my own career, it has been well behaved between call it the zero bound and say 2% for decades, which means that during the tequila crisis in 1994, the Fed was able to paper that crisis over with monetary stimulus. Ditto for 1998, ditto for 2000, 2001, ditto for 2008, ditto for 2020, every single time, right? Because of the lack of inflation. This time, though, if you look at that chart of core PCE, it's boom, popped way out, and it's proven to be sticky at around the 5% mark. And so everybody's already belly aching about how the Fed needs to cut, and that's definitely priced into the yield curve. But we literally have just gotten into positive real rate territory just now. So I think what I am concerned about for a number of different asset classes is that the recency bias, not of the last 1 to even 5 years, but the recency bias of the last several decades has led us to think that at the first whiff of any sort of recession, the Fed is going to tuck tail and run. But this time is different because just by judging by that long-term chart of the core PCE, it is very, very different. And so the reaction function, I think, will be different. And, you know, that's kind of a scary thing. That's why it does cloud my short-term view on oil, because I've not seen any sort of recessionary backdrop where oil didn't fall very precipitously. And this, you know, what we've seen so far is really not that precipitous, and it just depends on what OPEC does now.
Just a story from Berkshire this last weekend. I met a woman who was from Brazil, and I was asking her kind of what was her lived experience of the inflation there for basically all of her lifetime. And she said that, you know, right now it's back down below 5% in Brazil, and basically like no one believes it will stay there. So this is like the other side of the coin from sort of the US PCE experience of.
Well, let me tell you my own experience. I just got back from 2 weeks traveling to Egypt and Jordan. Okay. The Egyptian pound, by the way, 6 months ago was 18 to $1. Okay. When we went, it was 31 to 1, but the black market street rate was 42 to 1. And so listen to this heartbreaking story. My tour guide, the guide that was with us for the 5 days that we were in Egypt, and she's definitely one of the folks that are better off in that economy, right? She said that a couple of months ago, she sold her used car because she wanted to trade up. But within 2 weeks of her selling that car, the price of her used car had gone up 50%. She not only could no longer afford the trade up, she couldn't even afford to buy her own car back. She had to beg the buyer of her car to sell it back to her at 25% above what she sold it for. I mean, that's how brutal hyperinflation is, especially in a developing economy like that.
So this is what this woman was saying, that is one of the outgrowths of that, and it's a perfect example, is that no one will commit then to long-term contracts because you can't know what anything is going to be. And so if you end up like no long-term
which exacerbates the inflation.
Right. And so you end up in a very low trust environment at that point, because no one can like trust each other longer than, 6 months when the prices are moving that much. Yeah. And I think it's very expensive to run a society in a low trust environment. I think that's actually been one of the keys to the US's success, is that we have an extremely high trust environment, and it lowers the friction of doing economic activity between humans.
Well, that's why I do think, though, that the Fed, and Jay Powell in particular, understands the cost of letting inflation expectations get unanchored, right? Because at the end of the day, and I always have to caveat this by saying I don't want to sound insensitive about job losses, but when you look at the unemployment rate at 3.4%, and the delta between that 3.4% and what the Fed has jawboned, where it would like to see unemployment go, call it 4.6%, that's not a job loss of 100,000 jobs. That's a job loss of between 1.5 to 2 million jobs. So why do people need to lose their jobs? Because unfortunately, the Fed has one tool. It is monetary policy. And the one tool that they have is to sledgehammer the economy into submission to lower aggregate demand up for goods and services. And the only way to lower aggregate demand for goods and services is to create job losses. But I have to point out that inflation, though, is the most regressive tax at all. So while it's going to be brutal for the 1.5 to 2 million people that lose their jobs, having inflation run rampant affects 350 million people just in our country, of course. Globally, it's affecting the entire world, right? So it's not like we're alone in fighting inflation. I think Europe and England have a much bigger problem on their hands because they have much higher level of inflation and structural impediments that disallow their central banks to be as aggressive as our Fed, in my opinion.
What about the fiscal side? I mean, seems like even if Powell wants to be hard, we're still running trillion-dollar deficits.
Remember that song by Sammy Hagar, I Can't Drive 55? I got one foot on the gas and 1 foot on the brake.
Yeah.
Well, that's what's happening, right? I also call it the vodka Red Bull economy. I mean, it can't be healthy for the heart, right? When you're administering a depressant at the same time you're administering a stimulant.
That's a real young man's game, those vodka Red Bulls.
Yeah.
Jay Powell got a question from Elizabeth Warren where she said, what would you say to the families, the 1 or 2 million families who are going to lose their jobs? And he gave an answer that was very similar to yours. He said that he's looking after the 100 million or so other families by raising the rates to control the inflation. So I think that's where he's publicly, that's where he is.
That's what I heard in this recent presser, right? I think to me, the money phrase that I wrote in my recent Substack was exactly that he said that inflation, it is actually the most pernicious tax on the people least equipped to afford it. And look, I think my trip to Egypt is a stark reminder of what happens when inflation gets out of control.
Mike, absolutely fascinating. We're coming up on time here. The 2 places where people can find you, you're on Twitter at Urban Kaoboy, Kaoboy. I should point out to people. I will link it up in the show notes. And your Substack is great as well. It's Urban Kaoboy as well.
Yep.
But this has been a really fantastic, wide-ranging discussion. Really appreciate you providing your insights. Absolutely fascinating.
Thank you for taking me down memory lane. I didn't anticipate that, but that was fun. I like that.
It was good chatting, and we'll be back next week, folks. I'm not entirely sure who we've got, but we've got a great guest.
You'll be here, Toby. I'll probably be here.